Stop refreshing the price. Stop arguing about whether silver is going to $90 or back to $70. This week, the price is not the story. Structure is the story, and structure has a deadline. Friday, February 27th, 5 days from now. Silver closed Friday at 84.52 Oz. Gold also moved sharply. Headlines focus on momentum, resistance levels, and technicals. But that's noise. The real question is simple. Where is the physical silver? Not ETFs, not paper contracts, not leveraged positions, actual, deliverable metal. The March futures contract is approaching first notice day on the COMEX, which operates the US silver futures market. When the clock hits zero, every open contract becomes a real-world obligation. Each silver futures contract represents 5,000 ounces, worth over $400,000 at current prices. Right now, open interest in the March contract represents hundreds of millions of ounces in theoretical delivery demand, while registered silver, metal approved and available for delivery, is only a fraction of that. Most contracts never go to delivery because traders close or roll positions before first notice day. That is normal. But this month is different. Inventory has been declining for months. Registered silver in COMEX warehouses has been trending lower. And eligible metal that could become deliverable has also been drawn down. At the same time, global silver demand remains structurally tight. Industrial consumption, from solar, electronics, and EV production, has exceeded new mine supply plus recycling for several consecutive years, creating a persistent deficit. When inventories shrink into a major delivery month, leverage becomes dangerous. Since late last year, the CME has raised margin requirements multiple times. Margin is the capital required to hold a futures position. Raising it forces weaker participants out. If you triple margin over a few months, speculative longs disappear. Over-leveraged traders exit. What remains are stronger hands. Industrial participants and deep-pocketed funds. That changes the character of the remaining open interest. Silver recently rebounded sharply from its February low, while margin remained high. This was not retail excitement. This was positioning. Short sellers who do not hold physical metal must eventually close or deliver. If they cannot source metal cheaply, they buy back contracts, and that buying can accelerate into first notice day. The dates that matter are clear. Thursday, February 26th, is the last trading day before first notice risk becomes real. Anyone who does not want delivery typically exits by this point. Friday, February 27th, is first notice day. Shorts can issue delivery notices. Once assigned, the long must pay and accept the silver. Monday, March 2nd, is the earliest actual delivery transfer. The long does not control timing. The short does. If a short issues notice and does not have metal lined up, they must acquire it immediately or offset the contract at market prices. This is where stress can appear. The CME is not likely to default in the dramatic sense. It is structured with cash settlement mechanisms. But if participants expecting physical silver are instead paid cash, the credibility of the futures price as a true reflection of physical supply is damaged. That is the real risk, not collapse. Credibility. This week, watch registered inventory levels. If they fall further, supply tightens. If they rise suddenly, metal may be rushing into the system. Watch March open interest. If it drops sharply by Thursday, pressure may ease. If it remains high, more contracts could stand for delivery. Watch price versus open interest. Rising prices with stubborn open interest indicate short covering under pressure. Watch any CME announcements, such as margin changes or rule adjustments, as signals of institutional concern. Silver is both a monetary and industrial metal, which makes delivery months critical. If you hold physical silver, coins, bars, allocated vault metal, you are outside the leverage structure. You face no margin calls, forced liquidation, or reliance on warehouse accounting. You own the asset others are obligated to find. This is the asymmetry. This week is not about predicting $90 or $70. It is about observing how a leveraged paper system reconciles with physical constraints. Open interest may collapse smoothly, inventory may stabilize, or the data may reveal something more concerning. Either way, the numbers will tell the story. Watch inventory, watch open interest, watch the slope, not the headlines. When first notice day arrives, contracts stop being theory and become obligations. Obligations are where markets reveal the truth.